State the meaning and purpose of the basic accounting concepts. Basic accounting concepts. Accounting concepts are the fundamental ideas, rules, or basic assumptions that should be followed in the preparation of all accounts and financial statements. Business entity concepts. The business and its owners are two separate entities. Money measurement concept. All transactions of the business are recorded in terms of money. It provides a common unit of measurement. Going concern concept. This assumes that the business will continue in operational existence for the foreseeable future. Accounting period concept. An accounting period is the span of time covered by a set of financial statements. This period defines the time range over which business transactions are accumulated into financial statements and is needed by investors so that they can compare the results of successive time periods. Cost concept. As per this concept, all the assets of a firm are required to be recorded at their purchase price instead of their current value. Dual aspect concept. This is the basic principle of accounting. It states that every transaction will have dual effects, that is, every debit has a corresponding credit and vice versa. Therefore, at least two accounts will be involved in recording a transaction. Revenue recognition or realization concept. It means that the revenue of a business transaction should be included in the accounting records only when it is realized. Matching concepts. As per this concept, revenues are recognized when they are earned, but not when cash is received. And expenses are recognized when they are incurred, but not when cash is paid. Full disclosure concept. This means that financial statements should be prepared to reflect a true and fair view of the financial position and performance of the enterprise. Consistency concept. It states that the accounting principles and practices followed by a firm should be consistent over a period of time. This allows both inter-firm and inter-period comparisons. Conservatism concept. Prudence is a policy of anticipating possible future losses but not future gains. This policy tends to understate rather than overstate net assets and net income, and therefore lead companies to play safe. Materiality concept. The materiality concept of accounting states that all materials items must be properly reported in financial statements. The items that have very little or no impact on a user's decision are termed as immaterial or insignificant items, and these need not to be disclosed. Objectivity concept. It states that accounting information and financial reporting should be free from bias and capable of independent verification. This means that accounting information must be based on research and facts, not merely a preparer's opinion. The objectivity principle is aimed at making financial statements more relevant and reliable.